Today, we will talk about hot IPOs and what they mean for companies and investors. When a company goes public by issuing stock for the first time with significant demand, it's called a hot IPO. These IPOs draw a lot of interest from the media and investors even before they hit the market. However, investing in hot IPOs can be risky, especially if the company doesn't have a proven track record of success. Private companies that want to go public issue stock through an initial public offering, which allows them to raise a substantial amount of money in a short time, particularly if the IPO attracts public attention and becomes a hot IPO. The first step is for the company to find an investment bank to act as an underwriter. The underwriter markets the IPO and helps the company set a per-share price. The underwriter banks collect a portion of the sale proceeds as a fee. Hot IPOs often lead to a significant rise in share prices soon after they begin trading, but this sharp increase is often not sustainable, leading to a drop in price. Hot IPOs appeal to investors who anticipate that the demand for shares will outstrip the number of shares offered. These IPOs are often oversubscribed, making them a target for both short-term speculators and long-term investors. Underwriters must balance the size of the IPO with the appropriate price for the level of interest in the offering to maximize profits for the company and its underwriter banks. If a hot IPO is underpriced, the stock price will likely rise rapidly after the shares begin trading, while an overpriced IPO can lead to a rapid fall in prices. An example of a hot IPO is Facebook's initial public offering in early 2012. Analysts anticipated an oversubscribed IPO, and when the market opened, there was a higher demand for the company's shares than it offered. To fulfill investor demand, Facebook increased the number of shares and raised the price range. However, it quickly became clear that Facebook was not oversubscribed at its IPO price, as the stock fell precipitously in its first 4 months of trading. Here are 5 key takeaways. 1. A hot IPO is an initial public offering that garners great interest from the media and demand from investors. 2. Higher demand leads to sharp price increases in the secondary market, which are generally not sustainable. 3. Companies bring in at least one bank to underwrite and handle the pricing, marketing, and decisions about the number of shares and share price range. 4. The demand for shares in a hot IPO surpasses the initial supply, which means the price needs to be revised upward. 5. Underpriced hot IPOs will likely see their stock price rise after the shares begin trading while the stock price drops for overpriced ones. Hope this would help. Thanks for watching.